In 2022, people were panic selling at 30% losses. I was buying. And the difference wasn't courage. It wasn't intelligence. It wasn't even experience. It was cash. I'm Olivia, and today I'm breaking down exactly how I structure my strategic cash position, the system that lets me stay calm during market crashes while everyone else is scrambling. Because cash isn't dead money, it's leverage. Most investors make one of two mistakes. They either hoard too much cash, quietly losing to inflation every year, or they stay almost fully invested, and the moment life happens, they're forced to sell at the worst possible time. I learned this early. I was aggressively investing. Every dollar had to be working. Then my car needed $2,000 in repairs. The market was down 12%, and I had to sell stocks at a loss just to fix my car. That moment changed how I view cash forever, because I realized something uncomfortable. How I hold cash determines whether I build wealth or interrupt it. Now I structure cash in 3 buckets. Each one has a job. Bucket 1, the foundation, 3 to 6 months expenses. This is my emergency fund, non-negotiable. Mine sits in a high-yield savings account earning around 4 to 5% right now. Not exciting, not impressive, but that's not its job. Its job is protection. How I calculated it. I pulled 6 months of actual spending, rent, groceries, insurance, minimum debt payments. Not what I wish I spent, what I actually spend. That number became my floor. This bucket exists so I never, ever have to sell investments in an emergency again. Bucket 2, the opportunity fund, 10 to 20% of portfolio. This is where strategy becomes power. Most people watch recessions happen. I prepare for them. My opportunity fund sits in cash equivalents, waiting. In 2022, when tech stocks dropped 30 to 40%, I didn't panic. I deployed. Over 3 months, I invested in companies I'd been tracking for years, at discounts I may never see again. That wasn't luck. That was liquidity. Here's how I build it. When I get paid, 15% goes to long-term investments. 5% goes to my opportunity fund. During stable markets, it grows quietly. When markets drop hard, I become a buyer. Cash turns fear into advantage. Bucket 3, the transition fund, 1 to 3 year goals. If I need money within 3 years, it does not go in stocks. Period. House down payment, business investment, major move, that money lives in short-term treasuries or CD ladders earning around 4.5 to 5%. No volatility, no gambling, no, hopefully the market cooperates. If I know I'll need the money soon, I remove uncertainty because markets don't care about my timeline. Here's what changed everything for me. I stopped seeing cash as lazy money and started seeing it as positioning. Think about chess. You don't push every piece forward at once. You keep reserves. You wait. You let your opponent overextend. That's what overleveraged investors do during bull markets. They stretch too far. And when volatility hits, they're forced to retreat. Cash gives you patience. And patience turns volatility into wealth. Peace is underrated in investing. I don't invest to feel adrenaline. I invest so my future feels stable. Strategic cash lets me sleep at night. That's worth more than chasing an extra 2% return. So let me ask you something. If the market dropped 25% tomorrow, would you panic? Or would you deploy? Do you have true emergency protection? Do you have opportunity capital? Or are you fully exposed? Because after multiple market cycles, here's what I know. The investors who win during recessions aren't the ones who made the most during bull markets. They're the ones who had cash when everyone else didn't. Start with bucket 1. Build your foundation. Then grow into the others. If you want my full recession-proof allocation breakdown, it's linked below. I'm Olivia. Build your position. Stay strategic. And I'll see you in the next one.